All right, so guess what, everybody? We are going into a recession. This episode is going to be all about financial markets, how this stuff kind of works, and crypto, how it also plays in. Welcome and welcome back to the Gen Ed Show. Enjoy. You heard me right. There's a recent article, probably might link it into the comments, might not. Point in it being is that CEOs are no longer feeling all too confident that we're not going to be going into a recession. But are we really that surprised? I feel like everyone's kind of already known that after the induced recession and then just kind of how everything has played out on the world stage. So what the heck? Let's kind of go back a bit so we can understand more specifically when it comes to financial markets and how these can really play in and what their purpose is in a lot of these. So first thing I always love to start with is, especially if you paid some attention in history class from school, hopefully the education system didn't fail you too much, but they talked about the Dutch East India Company. Okay, this is out in back in the 17th century, Dutch East India Company. This was kind of like the first New York Stock Exchange to ever exist, if you will. Some consider it to be basically one of the biggest companies to ever exist, because I don't think it was really a company, and although we call it that, it really was just a conglomeration of people with a lot of money who wanted to make a lot of more money, right? And then especially helping in the passage of goods in across the world. So when we look at the US is definitely considered to be one of the most laissez-faire economic policy type places. And I say that almost kind of hesitantly because I'm not totally sure if that's the case. Laissez-faire would mean more of like a free market idea. And with that, at least in my opinion, I think of laissez-faire and free markets as capitalism. And capitalism would mean a lot more free trade, free flow of goods. That's kind of the problem though. For example, power companies. How the heck does that work? You've got one, maybe two in a state. How is that not basically a monopoly, right? Where only there's one option and they basically set the price? Or same thing when it comes to an oligopoly or oligopoly, right? And with oligarchs, where it's not a monopoly where there's only one, it's where there's several. And they basically divide up the entire market and set the prices. For example, you ever gone to a store and it talks about how there's, you know, if you find that another store has a lower price, it's called price matching. You've seen it, right? Okay. So the thing is that with price matching, the you think you're getting the better deal, don't you? So you can also get a good idea of this from the other book, Joy of Game Theory. I might have referenced it in one of the other episodes, but with it, it's a really good book. I highly encourage you to read it. And so in it, price matching. The idea is that, all right, I'm selling this for $3 and you might be selling this for $2.50, right? So like, hey, we can continue to compete against each other for that customer's money. But how about this? Whatever you set it at, I'll match it. Whatever you set it at, or whatever I set it at, you match it. And then maybe we just raise it up a little bit so that, you know, they feel like they win and we get to win. You want to do that? Real simple. Like that's basically what's going on. Okay. You're right. It's like, hey, you're going to win because we're going to match it to the lowest competitor. It's like, well, we also spoke to the competitors and we just kind of all agreed to just jump it up a little bit. Now, I'm not totally trying to say that there's an unethical practice or there's some level of price gouging, although there is a level of like the market not being able to correct itself naturally against that type of possibility, because then you have regulations. I think insurance companies are a very good example of this. One thing is to have insurance willingly, and another is to be absolutely required to have insurance, and especially, for example, the trucking business. Just because we're new, and we can have a good driving history individually, but because we're new, we don't have a safety rating. And because of that, we get basically almost our entire insurance policy doubling because of that singular fact. Now, thankfully, a year from now, no problem. We'll have a safety rating, and then they'll go ahead and drop it down. But it's 1 year of us paying an extra 20 grand for what? For what? For what, dude? For what? On top of the other? It doesn't make sense. But they can do that because it's required, right? Regulations tend to be a pretty tough thing. For example, minimum wage can be a really tough concept or conversation. And for example, it's very often you'll see like medium to small size businesses that are like, no, please do not. And then like mega companies like Amazon and Google, they're like, yes, minimum wage. Well, why would they not want that to happen? That makes total sense for them, because then all of their potential competition now has a much higher barrier of entry. For example, within the trucking business, if you don't have at least $80,000 for your first year of your own money, whether you have it already there or you are like actively earning it alongside your trucking business, dude, you're not getting started. Like you're gonna get hit with some significant financial wins, because that's just how this works. There's barriers of entry to every industry. And of course the mega companies want the minimum wage to increase, because then it's not like it is going to do anything to combat inflation, right? Because hey, let's just keep making everything cost more, and just because the numbers are bigger, now everyone gets paid more. That doesn't make any sense. Like, we don't live in Venezuela, and this isn't Zimbabwe. Okay, just because I can have a piece of paper that says I have $1 trillion, what does that actually mean if it's not worth much? Like if it's not worth $1 of something else, right? That's why minimum wage doesn't change anything. It's a band-aid for a different problem, you know? And so the point in this, coming into financial markets, is that the US is considered generally to be the most economically free, because at least it's not the most economically stratified. People do have the opportunity of being able to definitely progress in economic, privilege, unlike other places, most in the US compared to many other places. So with it, the stock market is a really good indicator to this reality. So the stock market has literally been around now for, and I looked it up, exactly 230 years. Okay, 230 years ago is when the stock market first started with the New York Stock Exchange in 1792. And so then from there, this is where we start seeing the conglomeration of businesses, and especially investing into these businesses on a more average and a more popularized place. And so with it then comes a couple hundred years, or about 120 years. In 1913, the Federal Reserve Act. And this was when the government said, the Federal Reserve is our central banking authority, and all things concerning finance are governed by this one body. Which, on a governmental point, I can understand that. Helps consolidation of power. It helps make sure that they have control to then disseminate the money and control the flow, make sure it's at different places. And then this is where you start to get a global reserve currency. So what is a global reserve currency? Well, a global reserve currency is where you have America's money, for example. And in America, it can be worth, however much it would be worth within that economy. But the thing is that if there were to be other people, does this matter to anybody else? Like, why should the American dollar matter to someone in Iran, or someone in Australia, or someone in Russia, or someone in Europe? Like, why should someone care? And this is why global reserve currency is important, because what you do is you spread it out everywhere, right? And just literally, they take a ton of the US dollars and they just sent it all over the world, okay? And this is what starts to create, a vacuum of sorts, or the inverse of, because now there's money in different places. And so this starts to create a law of supply and demand, right? There's more of it in one place and less of it in others. So it'll be more worth it in different places. And then this is where, especially nowadays, the US is in a big battle with China when it comes to being the only global reserve currency. China is doing a really great job of that, and I'm willing to believe that the U.S. is not going to be the global reserve currency for that long. I really do hope, because I'm American, and it's really convenient to me if that's the case, but we'll see. So from there, then comes August 15th, 1971. Nixon takes us off of the gold standard. So now the US dollar is no longer pegged to something. For example, if you were to go to Vietnam and have a US dollar before 1971, you would be able to go anywhere and that would be worth a certain amount of gold, for sure. And then Nixon took us off. So what that means is that the currency is no longer pegged to anything, which there isn't anything inherently bad about that. I mean, everything's been working fine, and everything can reasonably work fine, because what it really did was, instead of having it pegged to gold, now the US dollar was pegged to America. Okay? It was, what do we believe America is worth? And so to this point, what do we believe the country is worth? This brings us into the idea of credit. So credit is a pretty unique human understanding that we came to. And it seems so obvious now that, yes, obviously I'm going to make more money in the future. Why can't I borrow money from my future self to pay for something now? I'm going to earn it anyway. That was actually a very, very, very hard concept for a lot of people, because but I don't see money in my hand right now. How does no, I don't want a piece of paper saying you're going to pay me next month. I want money now. And when humans finally, and I believe the Renaissance is kind of where it came around, a really good book that encompasses this beautifully. I had a very, very hard time putting it down. It's like 500, 600 pages. It's called Sapiens by Yuval Noah Harari. Beautiful book. Really, really, really great. It's called Sapiens, A Brief History of Humankind. Really, really encourage you to read it. And the moment that humans were able to understand credit is the moment that everything changed, because then now we were able to invest into our future by borrowing from the future. When done reasonably and responsibly, it can go very well. Obviously, we're going to talk about how it won't go well if you're not careful. So with it, let's talk a little bit more. Okay, so now Nixon takes us off. It's 1971. We are a fully speculation-based currency, all right? It is fully fiat money. It no longer has any true value. It is fully pegged to the speculation, the belief that America will continue to increase in value, and so the dollar will continue to be something of value. So, oh, the irony. You know, there's always the comments, right, about boomers and the boomer generation. Dude, just like, so we're clear, Nixon taking us off the gold standard, 100% was the boomer generation officially passing all economic burdens into the future children. Hey, grandkids, your problem. You get to pay for our retirement. That's literally what happened. Anyway, so coupled with the internet, money is technically now not hard to get. You know, you ever heard the saying, money doesn't grow on trees? Well, ever since August 12th or August 15th, ever since August 15th of 1971 with Richard Nixon, money has officially grown on trees. Money can literally be printed, right? You just need certain types of fabric, and you need certain types of paper, and certain types of ink, and certain types of laser technology, but it's literally printable. And so with that, humans figured out that you can do this. Now, investor beware, okay? If there is ever a good bet, the bet is always going to be on yourself. If we take some wise words from Warren Buffett, the best investment is always in yourself. And so with it, you want to invest in yourself. That's always going to be a good bet. And at the same time is you don't want to bet on something unless you feel absolutely positive. For example, 200 grand that I used to buy these trucks to start this business, I know I'm definitely putting down a lot of my own money, like the 80 grand I just recently mentioned. And on top of that, I have to be $200,000 positive. I'm going to make this back, right? So I can get funding, and obviously there's some credit background that you need to have, and some things that you need to be able to show so that they feel confident in lending you that much money. But you get the idea. So from here, you want to make sure that if you're going to bet on something, bet on yourself. It's always going to be the best investment, and to be dang positive. Do your research before you go ahead and put money where your mouth is, right? You don't want to get caught with your pants down. It's not going to be fun. And so with it, let's use an example. What do the wealthiest people do? What do the wealthiest companies do? For example, Apple, Amazon, Google, these businesses have some of the most cash reserves that any business has ever had, like just liquid cash ready to go. So why is it that if they want to do, let's say, like Intel, I believe, wants to put $40 billion towards building a microchip or computer chip manufacturing plant, okay? Because, and this ties into the whole China idea, because China doesn't believe that Taiwan is a sovereign country. And so because of this, they want to take Taiwan. But if that happens, then Taiwan being the only place where you can get high quality computer chips is going to then obviously create a big ripple in the global technology market. Okay, so what do these big companies do? They have a $40 billion project. Heck, Elon Musk is actually an even better example of this. What did Elon Musk do? $44 billion, $42 billion, $46 billion, whatever. Got 22 of his own billion, right? Half, and then got the other half funded. When these companies and these people have large things to fund, they're not paying for it all by themselves with their own money. Not that they couldn't, but why would you? Because if you do, now you're just spending money. You still get taxed on it as normal. And now you're out of cash, or a lot less. So instead, if you go ahead and borrow it, let's say at 1% interest, 10% interest, kind of, again, depends on your credit and who you are. But these companies will get it at 1%. Say 40 billion at 1%. Now they have everything, they build everything, they start making money off of that thing, and then they never actually spent any money. None of theirs. So then they just get to keep all the profit. It's the same idea here, guys. For example, if you wanted to get into the commercial trucking business, one of the things they love to see is just the fact that you buy a lot of cars. Having a lot of auto loans. If you bought a lot of cars and you paid off a lot of cars, like, they love that. They're going to love you, right? Because it's auto loans, home loans, a type of classification of loan. The more history, the more they're going to love, because this is what these financial markets are all based on, right? Again, 1913, Federal Reserve is now the central banking authority, okay? All things are now based on this central authority. So if you really want to make it in a game, they literally just gamified the economy, because that's just how it works. Before, you could literally go and dig up in any place you want. And if you found gold, there's your gold, there's your money. And then 1971, Richard Nixon got rid of that idea, and you can only print it if you're a government, right? Otherwise, you go to jail. So otherwise, you're bartering, right? And you're not. You have to find more creative ways like companies do. So with it, the stock markets were the thermometer. Ever since 1971, stock markets just became speculative thermometers. So this is a very roundabout way of talking about the stock markets. And also, to keep for yourself, low index trade funds are always a very good and safe investment. Technically, I have to say that this is not financial advice, but I kind of feel confident in it, and this is at least what I do. So take it with a grain of salt. But low index trade funds are wonderful. You can read about it in Money Master the Game by Tony Robbins, because the idea is that the stock market's been around for 230 years with annualized rates of return of 10.7%. So adjusting for inflation, and if you adjust for inflation currently at the time of this recording, it's going to be like 10%. Well, then you'd still be able to earn 0.7%. Now, typically inflation isn't this aggressive. It's typically you'd get about 2, maybe 3% inflation. That's what economists expect, maybe 4. So let's say it's 4% and you have a 10% annual rate of return. And then from there, you take home 6% rate of return. That's pretty nice. It's respectable, it's dependable, and if you have $650,000 at 6% annual rate of return, you'll have about $36,000 each year, or about $3,000 every month. Pretty convenient. So with it, this is a really, really great point to then make, segueing from stock markets to crypto, and that being the story of Bernie Madoff. If you don't know about Bernie Madoff, let me tell you about this guy. So if you've never heard about a Ponzi scheme, this is the guy that is basically the godfather of a Ponzi scheme. Okay, so this dude going around the stock market would get investors to invest into his company. And so the great thing is that obviously, hey, you invest into our company, I can promise you that this thing is going to continue to go up. You're going to continue to make these type of percentage returns, and you're going to be really, really happy. So much happy that you're going to go ahead and continue to invest, and you're going to invest more and more and more. Okay. And literally people just took this man's word for it. Hey, invest your money here. I guarantee you, you're going to make at least this return, and you're going to be happy. People are like, yes, Bernie, you seem to be very successful. You seem to have a ton of money. I believe you. So how did Bernie get this money? Well, you get one wealthy person and you get their money. And then you get another wealthy person and you get their money, right? And now let's say that that is equaling $1 million. Or probably that's not even enough. Let's say that's equaling 100 million or 50 million, $10 million, 5 million and 5 million. Sure. Decent investors. So now you got $5 million going on right there. Cool. Now, hey, I want to promise them a return on their investment. Let me see if I can go find 2 more investors to give me $5 more million each. So now the 10 million turns into 20 million. Hey guys, Mr. Investors, you have now had 100% rate of return. Wow. Oh my goodness. I'm going to invest even more. This is great. Wow. And literally this dude, Bernie Madoff, would just continue to get people to just keep paying money based on the idea, just straight up the idea that the company was going to continue to go up and they were going to continue to make money. That is because, well, eventually someone wants to cash out. And Bernie, why do you have a hard time letting me cash out my money? I made great returns. I want to take some profits. Well, it's going to keep going up. Please don't take out your money, actually. Wait, what's the problem, right? And then if he had, which he did, enough people want to take out enough money soon enough, then that would technically make the numbers start to go down and then not be as good of an investment, and then you could have a dip. And he can't afford a dip because there was no product, there was no service, there was no actual offer, there was no actual business. People were literally just paying into a Ponzi scheme. So this is what's happening in crypto a lot. I like to view crypto and the crypto markets with Bitcoin, Ethereum, and all of the different altcoins that you can imagine as basically just being another stock market. So that more in the case of Bitcoin being like digital gold, and Ethereum being the actual first New York Stock Exchange, if you will, or at least the most popular that we all come to recognize, especially if you're in crypto. And so with it, since it follows a lot of this, what's convenient is that the investment strategies are pretty much similar and the investment dangers are pretty much similar. All right, so crypto came around, I believe, as a digital manifestation of the same habits that we as humans and as a society already brought together 230 years ago, first in America, and then obviously as it's spread around to the London Stock Exchange and then China, and then all the different stock exchanges you get. So with crypto, now we start to see potential other Ponzi schemes. This is the first thing I want to talk about just as far as buyer beware. And then from there, what to actually do when you're trying to invest into crypto. So when it comes to investing into crypto, you want to be very, very, very careful to avoid, in my opinion, anything speculation based. I so much believe this that I try not to. In fact, I think I do a very good job of not holding on to fiat money just because I don't like to hold on to speculation based assets. And the US dollar is a speculation based asset. Technically, the Russian dollar is, if I'm not mistaken, I believe been pegged to gold. And so that would technically have an asset. I am not buying Russian dollars, but I think you get my point, right? Something that I can definitely feel confident about. And not to say I don't feel confident in the US dollar, but I definitely feel very more confident in, like, for example, box trucks that are definitely going to hold their value, right? Or actually just buying gold, or buying property, or buying really great equipment like the camera that this is bought on, or that this is shot on. Those types of things, you get me? So be very careful when you're looking at crypto. The beauty in it is that it is a digital technology using Web3 layer, or web layer 3 applications, the blockchain technology, so that this way they're able to solve very sophisticated digital problems in a decentralized manner. Sounds super complicated, but basically really great programming shit. And the people that can do this are truly incredible. And so we need to be able to nurture it. And there are great projects out there that are solving legitimate problems, or at least trying to, right? And legitimately working to make super useful, applicable technologies to day in a decentralized manner. And with that, they have coins, tickers that allow someone to invest into it the same way someone would with a stock. The beauty is that you don't need to be crushing it, 8, 9, 10 figure business and go, IPO or do an initial public offering. No, you can literally create the technology and you can host it and launch it onto a network like Ethereum, or like Sushi Swap, or like Pancake Swap, or like Uniswap, or you get the idea. There's a lot of exchanges. So you can buy through all these different places. And then as you're going through that, just again, be very careful. Do your research. Look, a lot of people lost money on Luna. Luna is a perfect example. If you're not familiar with Luna, search it. We're talking $1.6 billion, if I'm not mistaken. Crash. Didn't crash. They stole it. This guy made a ton of money running a Ponzi scheme. And there's a lot of billionaires and a lot of multimillionaires now that's what is happening in that space. So you need to be very careful with it, because there is a level of Wild West. The SEC has not regulated it. And in fact, I don't think the SEC or the government should be involved, because I think, again, you just need to be very careful with how you're investing your money. Pay attention to the technology, the application behind it, and the people. Do your research. Look at the white papers, okay? Check around. Do a little bit of investing. See how you're feeling. Follow the trend for a little bit. Don't just FOMO in.